What is investing? Imagine Sarah, a regular person with a 9 to 5 job. Every month, she earns her paycheck, pays her bills, and maybe saves a bit. But Sarah doesn't just want to save. She wants her money to grow. She wants her future self to thank her for what she plants today. So instead of letting her cash just sit in her bank account doing nothing, Sarah decides to plant a money tree. She sets aside a small portion each month, $100, and invests it. At first, it's boring. Nothing seems to happen. A few months pass, and her investment looks almost the same. But she keeps watering that tree, month after month, year after year. And just like a real tree, something incredible happens over time. Fast forward 30 or 40 years, and Sarah doesn't just have a tree, she has a forest. That's investing. It's the act of putting your money into something that has the potential to grow in value over time, so your future self can live better than your present self. You can invest in many things: stocks, pieces of ownership in a company, bonds, loans you give to companies or governments in exchange for interest, real estate, property that can generate rent or rise in value, commodities, things like gold or oil, cryptocurrency, digital assets like Bitcoin or Ethereum, index funds and ETFs, baskets of many stocks bundled together to spread out your risk. You can even invest in yourself, learning new skills or education that can increase your earning power. Because sometimes, the best investment is the one that pays you more income later. Why not just save money? That's what Sarah used to do. She'd deposit her cash into a savings account and watch it sit there, safe, but still. Here's the catch. Your money in a bank doesn't grow fast enough to keep up with inflation. If inflation is 3% per year and your savings account earns only 0.5%, your money is actually losing value. The $100 you saved last year might only buy $97 worth of groceries next year. Meanwhile, the bank is using your deposits to invest, lending it out, buying bonds, even purchasing stocks, and earning profits from your money. So, when you choose to invest, you're essentially saying, I want my money to work for me, not just for my bank. Historically, the U.S. stock market, measured by the S&P 500, has returned an average of about 7 to 10% per year after inflation. That means if you invested $1,000 and left it for 40 years, it could grow to nearly $20,000 without you lifting a finger. Meanwhile, if you left that same $1,000 in a savings account earning 1% per year, you'd have about $1,500 in 40 years. Inflation alone would have eaten up most of your purchasing power. That's why investing isn't about being greedy. It's about staying ahead. It's about protecting your money's value in a world where everything, from groceries to rent, gets more expensive. There are two main ways people invest: actively and passively. Active investing is like being a chef. You pick your own ingredients, research companies, read charts, watch the markets daily, and try to buy low and sell high. Passive investing is more like ordering a pre-made meal plan that's designed by experts. You invest a fixed amount every month into index funds or ETFs and let time do the heavy lifting. Sarah, for instance, invests $100 every week in an S&P 500 index fund, regardless of whether the market is up or down. This method is called dollar-cost averaging, and it helps smooth out volatility. Sure, the market might drop one month and rise the next, but over decades, the upward trend has always won. Every investment carries some level of risk. Some are like steady hills, slow but reliable climbs. Others are like mountains, high peaks, but risky falls. For example, U.S. Treasury bonds are low risk but offer smaller returns. Stocks are higher risk, but historically offer greater long-term gains. Cryptocurrency can see 50% swings in a week, definitely high risk, high reward. The key is to find your balance. The younger you are, the more risk you can typically afford because you have time to recover from downturns. If you're closer to retirement, you might want to lean more towards stability and income-generating investments like bonds or dividend stocks. Imagine two friends, Alex and Jordan. Alex starts investing $200 a month at age 25. Jordan waits until age 35 but invests double, $400 a month. Both invest in the same stock index, earning 8% annually. At age 65, Alex's investments are worth about $586,000, while Jordan's are only $588,000, nearly the same. even though Jordan invested twice as much per month. The difference? Time. Compounding, the snowball effect of your returns earning more returns, is the most powerful force in investing. As Albert Einstein supposedly said, compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. Smart investors spread their investments across different asset classes. That's what's called diversification. If one stock crashes, others might rise, and your overall portfolio stays steady. For example, during the 2020 pandemic crash, tech stocks like Amazon and Zoom soared, while airlines and oil companies plunged. Diversification means you're not betting your entire future on one outcome. Index funds and ETFs are the easiest way to achieve this. A single S&P 500 index fund holds shares in companies like Apple, Microsoft, Johnson & Johnson, and hundreds more. That's instant diversification with one click. You don't need to be rich to start. In fact, you can begin with as little as $10 or $20 using modern investing apps like Fidelity, Vanguard, or Robinhood. Many platforms now allow fractional shares, meaning you can own a small piece of Amazon or Tesla without buying a full share. The most important part isn't how much you start with, it's that you start. Consistency beats intensity. Set up automatic contributions, invest regularly, and forget about it. Time and patience are your best allies. Many beginners lose money not because of bad investments, but because of bad behavior. Here are a few classic mistakes to avoid. Investing more than you can afford. Always keep an emergency fund first. Expecting quick results. Real investing is a marathon, not a sprint. Panic selling when the market dips. Remember, downturns are temporary, growth is permanent. Chasing trends. If everyone's talking about it on social media, you're probably late. The US stock market has crashed several times, 2000, 2008, 2020, but each time, it recovered and hit new highs. Historically, holding your investments has beaten trying to time the market. Investing isn't just numbers, it's emotions. Fear and greed are the biggest enemies of investors. When the market falls, people panic and sell. When it rises, people get greedy and buy at the top. But successful investors do the opposite. They stay calm, buy when prices are low, and stay invested for the long run. Warren Buffett's timeless advice sums it up. Be fearful when others are greedy, and greedy when others are fearful. Let's be honest, not investing is also a choice, but it's one that costs you in the long run. If you save $500 a month in cash for 30 years, you'll have $180,000. Sounds decent, but if you invest that same $500 at a modest 7% annual return, you'll have over $600,000. That's the cost of not investing. Almost $500,000 left on the table. So, where should you start? Start small. Pick an index fund like the S&P 500 or a total market ETF. Set up automatic contributions. Ignore the noise. Check your portfolio once or twice a year, not every day. The less you react emotionally, the better your returns will likely be. And remember, investing isn't about getting rich quick. It's about getting wealthy slowly, consistently, predictably, and sustainably. Investing is how ordinary people build extraordinary wealth. It's how teachers retire comfortably, how middle-class families send kids to college, and how everyday workers achieve financial independence. The key isn't timing the market or chasing trends. It's patience, discipline, and time in the market. Start planting your financial seeds today. In 30 years, you'll look back at your forest and thank yourself for every small step you took. Please subscribe, like, and share. We will see you in the next one.